Hello, everyone. Thank you so much for joining us again for our weekly wrap-up. My name is Jeremy Kronemeyer, Operations Manager for Wickham Financial Group, and I got Graham Wickham here, President and CEO of Wickham Financial and Insurance Services. Graham, tell us what happened in the markets last week.
Yeah, thank you, Jeremy. Thanks for everyone being on a call. I mean, it's a lot of volatility closing out the week. I mean, we had some weak labor data that came in, and that really spiked the fear on maybe earnings growth fear, a growth fear in the economy. Are we rolling into a recession? You name it, it happened. We'll spend some more time covering that probably at the end of the call. But so let's wrap up what happened to the market. So basically, the U.S. equities and treasuries both fell. We saw the Nasdaq down about 3.4%. The S&P was off about 2%. And the Russell small cap, get this, was down 6.5%. You know, add a day before or the following day, yeah, I think you wiped out everything that Russell rallied to, almost 10+% in a month, just wiped away. We saw the tech was really the biggest lagger. That struggled the most. What were the leaders? That was in utilities and real estate. Why? Well, if we believe that things are slowing down, maybe that's more reasons for the Fed to be more aggressive in cutting rates. That will positively affect utilities, real estate, so on and so forth. Labor data, that was kind of the source here, part of the source, and I'll get to that in a little bit. But we saw non-farm payrolls rise about 114,000. Now, that was the smallest gain since December 2020, increasing the unemployment rate to 4.3% to 4.1%. That's still not a huge move, and that is still an expansionary market, even at an unemployment rate of 4.3. But the market took that as its cue to start taking profits, among other things, which rightfully so. We've had a great market year to date. Why not take some profits with some fears that maybe there's a recession approaching? So we had the Federal Reserve come out. They did not raise interest rates. They did state that they're looking at September to be on the table for rate cuts. We looked at crude prices. They dropped about 3.2%. On the flip side of that, we saw gold rise too. Well, if the economy's slowing down and people are going to drive less, spend less, and travel and so forth, maybe using less gas, hence oil being down 3.2%. Safety trades, gold, it was up 2%. So you can kind of see why that happened. We look global in the global central banks. We saw the Bank of England cut rates for the first time in 4 years. And then we see the Bank of Japan. This is the big one here. The Bank of Japan raised rates on its plan to taper bond purchasing. So spiking their interest rates, causing a yen currency freakout, for lack of better terms, right? That caused a lot of drama on Friday. It started building momentum when the Japanese index was down about 16% on the yen curry trade that happened over the weekend, and it moved into yesterday, Monday. Internationally, we looked at the Eurozone inflation rose to about 2.6% year over year. And we saw inflation, China's manufacturing activity hit its 5-month low. Now, let's get into this week. A lot of drama already started out the week. Monday, because we record these on the Tuesday, we saw the follow through on the weekend with the yen carry trade. The unwind, if you might, on that, causing a lot of drama in the market, fear of recession, slow growth in the economy, maybe with earnings with companies, which has not reared its head yet, by the way. 78% of the S&P has reported earnings, roughly 78 or over 78 is reported earnings. 78% have been positive. And we're averaging about 11% growth here. That's pretty darn good. That's not a recession. So just keep that in mind as we see the drama or the volatility increase in this market. So we're still in the middle of earnings season. We're not quite in the middle of earnings season, more towards the latter half. But we have big ones coming out like Disney and Caterpillar, Super Microcomputer, Uber, and some Occidental Petroleum and others coming out. Global events, we'll see the Reserve Bank of Australia likely to keep rates steady. China released some inflation data. In Europe, we're looking at consumer confidence numbers coming out. And Germany, we'll see their manufacturing data to see how we're looking at in terms of their health with their economy. Jeremy?
Gotcha. We appreciate it, Graham. And you had
Yeah.
mentioned at the beginning of the call with the volatility from end of last week going into yesterday, and then you were talking about the international markets being a little crazy right now, but also what about the VIX? You were going to maybe talk about that and let the people know what's going on with the VIX.
Yeah, absolutely. Odd, year plus, the VIX has been really low. VIX is a measure of volatility, right? So when fear is high, VIX runs up. But when fear is low, it stays low. Well, it's been unusually low for what, a couple of years now? Hope I get that right or generally correct. It's been unusually low, below 20. Well, it spiked over 65. Listen, the last time we saw that was in the height of the pandemic. Obviously, we're not in a pandemic situation. We're not in some global collapse or currency situation at all, or a recession. There's nothing for that to happen besides what we think was an event with the yen kind of carry trade going on there, spiking volatility. The institutions maybe have to cover or sell to maybe cover margin calls, maybe to cover cash positions that are now costing them more. So on and so forth. Maybe some piling on when they see the anxiety and the volume in the market and the downside of the market. Hey, I want to go ahead and book some profits, and maybe that's a snowball effect too. I think it's a culmination of those two factors. And there's one interesting fact. The S&P, and it's not a VIX fact, but just volatility here. If we go back to 1927, since the S&P's origination, we've had 240. Listen to what I'm saying, 245% pullbacks in the market. They're not unusual. 5, 10%. If you've been on a call, listen to anything we talk about outside of just coming in the office and being a client of ours, you've heard us say you got to be prepared for pullbacks. 5, 10%, count on it. We've already had one. We've gotten our second one. The average drop is 11.8%. We fell intraday yesterday right around 9.7% on the S&P. Now, it's not a marker in the sand, doesn't mean we can't go a lot lower, but it seems a lot of work's already been done. Also, keep in mind, if we're worried about this yield curve inversion that you keep hearing about, well, the market's kind of been doing that for it. We are actually at one point, the curve from the 2s to 10s on the treasuries reinvert briefly. So the market is doing a lot of what the Fed job could be. Doesn't mean they're not going to lower rates. It just means the market's kind of ahead of this sometimes, correcting because of overvaluations and rotating in underappreciated areas like value, maybe a little international before we saw this pullback, small caps, so on and so forth, dividend boring payers, utilities, the real estate that kind of rallied a bit here, out of the stuff that outperformed the most, that growth in high PEs that are out there. So the market's, again, kind of doing what the market does. It kind of right sizes itself. Now, are we out of the woods? I do want to let everyone know, no, we're not going to necessarily be out of the woods. These things don't usually end overnight. It takes time. We might not be completely oversold in the market, but try to time it and get in and out. I think we know history proves it's pretty challenging to do that. So I would encourage everyone, stay the course, manage what you can in your portfolio. Make sure you got cash set aside in these great high yielding money markets that will be coming down as the Fed lowers rates. But if you need money in the next 6 to 12 months, those are some easier places to slide some cash over to, at least in the interim.
Gotcha. Well, we always appreciate the information, Graham, and thank you to our listeners. And again, we do have our retirement planning today classes coming up here on Thursday. Our first class is on Thursday, the 15th of this month. So if you haven't been to one of our classes, go check out our website or our Marietta Community Schools and sign up for that. And we look forward to having you, and we'll see you next week.
Take care.